Okay, let's unpack a crucial financial challenge. How do you actually protect a major investment from, well, the unpredictable swings of interest rates?
Yeah, it's a big one.
It's like trying to navigate a ship through a storm, knowing the tides could shift dramatically at any moment. That's the core puzzle we're diving into today. We're looking at a real-world scenario from a company called Wardegul Co. They've got a significant chunk of change in a foreign currency, the Euro dinar, that they need to invest.
Okay.
But they're facing some serious market uncertainty. Our mission is to explore how their treasury team can use different financial instruments to manage that risk and figure out, well, the smartest strategy.
That's right. Our goal today is to break down 3 key tools. You got forward rate agreements, interest rate futures, and then options on interest rate futures.
Right.
We'll look at how each one plays out under different market conditions, focusing on the bottom line impact, and maybe more importantly, why Wardegul Co. might choose one over the others. It's really about being prepared for whatever the market throws their way.
Okay, so let's set the stage for Wardegul Co.'s situation properly. They have this new subsidiary in Euro, right?
Yeah.
And they're expecting to receive a really substantial sum, D27,000. This isn't just pocket change. It's clearly a major investment for them.
Absolutely. Significant amount.
And the timing is, well, it seems absolutely crucial here. It's currently October 1st, 2017 in the scenario.
Okay.
They're not getting the money right away. They expect to receive it on January 31st, 2018. So that's, 4 months from now?
4 months out, correct.
And once they get it, they want to invest it for 5 months until June 30, 2018. So we're talking about a future investment with a future maturity date.
Exactly. And what's really fascinating here, I think, is the uncertainty Wardegul Co was navigating. The central bank base rate in Euro right now, October 1st, is 4.2%.
Okay, 4.2%.
But their treasury team's forecasts are painting quite a volatile picture. By the time they receive that 27 million dinars on January 31st, the base rate could increase by as much as 1.1% or might actually fall by up to 0.6%. That's a pretty significant range of potential movement.
Yeah.
And it directly impacts their investment earnings, obviously.
Yeah, hugely. And there's another crucial detail, right? The one that impacts their actual return. They can invest funds at the central bank base rate less 30 basis points.
Correct. 0.3%.
So whatever the base rate ends up being, their actual investment return will always be slightly lower. How significant is that difference in the grand scheme of things?
Oh, it's highly significant because it directly shaves off yield. It means they're always starting from, well, a slightly disadvantaged position compared to whatever the headline base rate is.
Right.
Given all this, Wardegul Co.'s treasury team is looking at their hedging options. And their internal guidelines, they're quite smart, actually.
How so?
They emphasize protecting against adverse movements, which makes total sense. You want to guard your downside. But they also allow for considering upside potential.
Ah, interesting.
Meaning they're not just playing it super safe. They're looking for strategies that perhaps offer both a safety net and a potential springboard if rates happen to move favorably for them.
Okay, that makes sense. So let's dive into the first tool Wardegul Co could use, forward rate agreements, or FRAs. How do these work in sort of simple terms?
Well, FRAs are essentially like locking in an interest rate for a future period directly with the bank. It's an over-the-counter agreement.
Okay, like agreeing on a price today for something later.
Exactly. For Wardegul Co, they need to invest in 4 months, right?
Yeah.
January 31st. And they want to lock in a rate for the 5-month period after that.
Right, until June 30th.
So the bank offered them what's called a 4.9 FRA at 5.02%. The 4 means it starts in 4 months.
Yeah,
and the 9 means it covers a period ending 9 months from today, which perfectly brackets their 5-month investment window from end of Jan to end of June.
Got it. So how would an FRA actually play out for Wardegul Co when the market inevitably moves? Let's walk through those 2 scenarios you mentioned.
Sure. Let's take scenario 1 first.
Right, scenario 1. Interest rates increase by 1.1%. So the base rate jumps to 5.3% by January 31st.
Right. Their direct investment, after that 30 basis point adjustment we talked about,
the haircut, yeah,
would earn 5.0%. On 27 million dinars over 5 months. You calculate that out, it's D562,500.
Okay.
Now here's the FRA part, because the actual rate, 5.3%, ended up higher than the FRA rate they locked in, the 5.02%. Wardegul actually has to make a payment to the bank. The difference, that payment works out to D31,500.
Okay, so they pay the difference.
Correct. So their net receipt after that payment is D531,000. Yeah. And if you calculate the effective annual interest rate, it comes out to 4.72%.
2.72%.
Yeah.
And now what about the other way? Scenario 2, rates fall by 0.6%, so down to 3.6%.
Yeah, much lower. That's only D371,250 from the direct investment itself.
Okay.
But this time, because the actual rate of 3.6% is lower than the Exactly. Wardegul Co. would receive a payment from the bank, and that receipt would be D159,750.
Right.
So you add that to their investment income and their net receipt, still D531,000.
The same number.
Exactly the same. And the effective annual interest rate, still 4.72%.
Wow.
And that's what's truly fascinating, I think, about the FRA in this context. It gives them rock-solid certainty.
Like a shock absorber.
Precisely.
Yeah.
It guarantees Wardegul Co. that consistent 4.72% effective annual interest rate, no matter how the market swings within those predicted ranges. That's pure predictability.
Which is often exactly what companies want.
Often, yes. Especially if cash flow certainty is paramount.
So the FRA offers that rock-solid certainty. But what if Wardegul Co. prefers, say, the flexibility of an exchange-traded product? Or maybe they're worried about their bank's stability, counterparty risk.
Okay, that's where interest rate futures come into the picture.
How do these differ fundamentally from an FRA?
Well, the big difference is that unlike FRAs, which are private agreements with one bank,
Over the counter, right.
Yeah. Futures are standardized contracts traded on a public exchange. That gives you a different kind of security, backed by the exchange's clearinghouse.
Okay. So for Wardegul Co.'s investment, which futures would they use?
They'd use the March contracts. That's the closest contract maturity date after their investment begins at the end of January.
Makes sense.
And each contract represents D500,000.
So to cover their D27 million investment for the 5 months, quick calculation, they'd need 90 contracts. Is that right? D27 meters divided by D500K times 5 months over the 3-month contract period.
Exactly right. 90 contracts. And here's where a concept called basis becomes important for futures.
Basis. Explain that simply.
Think of basis as the little bit of difference, the wiggle room between the actual market interest rate and the rate implied by the futures contract price at any given moment.
Okay.
It's a gap that exists because the futures contract hasn't matured yet. It gradually shrinks to zero as the contract approaches its expiry date.
Right.
So we calculate what's called an unexpired basis of 0.34 by January 31st. That's the small difference we still need to factor into our expected futures prices when they start the investment.
Okay, got it. So what does this all mean for the outcomes if they use futures? Let's see how these exchange-traded contracts protect them. Scenario 1 again.
Yep. Scenario 1, rates increase by 1.1% to 5.3%. Their actual investment, remember, still earns that D562,500.
Okay, same investment income.
Right. However, the futures price, which moves inversely to interest rates,
Goes down when rates go up.
Correct. It would have fallen.
Right.
Now, because Wardegul Co. would have bought long futures contracts to hedge against a fall in rates.
They lose money on the futures.
Exactly. They'd incur a loss on the futures contracts in this rising rate environment. It works out to around D47,250.
Okay.
So you subtract that loss from their investment income. Their net return would be D515,250.
D515,250.
Which gives them an effective annual interest rate of 4.58%.
4.58%. Okay. Now, scenario 2 with futures, rates fall by 0.6% to 3.6%.
Right. Their direct investment income is low. Again, remember, only D371,250. But this is where the hedge really kicks in. Because rates fell, the expected futures price would have risen.
So they make money on the futures side.
Precisely. They make a significant profit on their futures contracts, about D144,000.
Nice.
So you add that profit to their lower investment earnings, and their net receipt is D515,250.
The same again?
Exactly the same net return as in the rising rate scenario. And the effective annual interest rate, again, is 4.58%.
Interesting. So just like with FRAs, futures seem to provide a consistent effective rate across both scenarios, just slightly different at 4.58%.
That's correct. It locks in a rate, albeit through a different mechanism involving gains or losses on the exchange. And it's crucial to remember, like you said, when you're hedging an investment against a potential fall in interest rates, you effectively buy or go long interest rate futures.
Right.
This means you profit if interest rates drop, because the futures price rises, and that profit helps offset your lower investment income. Got it. Okay, finally, let's explore options on interest rate futures. This is where it can get a bit more complex, maybe, but also potentially more rewarding.
That's a good way to put it. Think of options as maybe a highly flexible insurance policy for your investment.
Insurance policy, I like that.
Unlike futures, where you're obligated to follow through, options give you the right, but crucially not the obligation, to buy or sell at a certain price.
Ah, the right, not the obligation. Key difference.
Absolutely. You pay a premium up front for that, right? For that flexibility.
Okay.
This means you can potentially benefit from favorable rate movements, but you're not locked into a loss if rates go against the direction you were hedging against.
So how does Wardegul Co. approach this flexibility? What kind of options are they looking at?
Well, they're looking for that strategic edge, remember. Mitigate downside, consider upside.
Right.
Since they're hedging an investment against a potential fall in interest rates, they would consider buying call options on interest rate futures. Call options? Why call options if they're worried about rates falling? That sounds counterintuitive.
It does, doesn't it? But here's the logic. Remember, interest rates and futures prices move inversely.
Okay, right.
So if interest rates fall, the futures price itself will rise. Their call option, which gives them the right to buy the future at a specific lower price, the exercise price, then becomes valuable. Exercising it generates a profit that helps offset their lower income from the actual investment.
Okay, that makes sense now. Clever. So they'd use the same March contracts.
Yes, same March contracts. And like with the futures hedge, they'd calculate they need 90 contracts.
Oh, 90 contracts.
And that unexpired basis calculation we did stays the same at 0.34.
Okay, basis 0.34. Got it. Now, I see there are two different call options Wardegul Co. is considering here, each with a different exercise price and, importantly, a different premium cost.
Correct. Different strike prices, different costs.
Let's look at the 94.25 exercise price option first. This one has a March call premium of 0.545%. That's the cost up front.
Right, 0.545% of the contract value per contract, adjusted for time.
Okay, scenario one with this option. Rates increase by 1.1% to 5.3%.
Right. The expected futures price, factoring in basis, would be 94.36.
94.36. And their exercise price is 94.25.
So since their exercise price of 94.25 is lower than the expected market futures price of 94.36, they would exercise the option. They can buy at 94.25 and immediately gain relative to the market.
Okay, so they exercise. They get their $562,500 from the main investment, plus a small gain from the options, right? The difference between 94.36 and 94.25 in basis points, that comes out to D12,375.
Correct.
So their net return lands at D513,562.
D513,562.
Which translates to an effective annual interest rate of 4.56%.
3.56%. Okay. Now, scenario two with the same 94.25 option, rates fall by 94.6% to 3.6%.
Okay. Here, the expected futures price would be much higher, 96.06.
96.06. Exercise price is still 94.25. So again, their exercise price is lower than the expected market futures price. They definitely exercise.
Right. Their actual investment earned less, though, only D371,250.
Correct. But the options really help here. The difference between 96.26 and 94.25 is much larger. That gives them a gain from the options of D203,625.
Wow, quite a bit.
Then you subtract that same premium cost, D61,313.
And the net return is D513,562 again.
Exactly. D513,562. And the effective annual interest rate remains 4.56%.
So this option, the 94.25 one, also seems to give a consistent outcome, just like the FRA in futures, but at 4.56%.
That's right. Notice how with this 94.25 option, the net return and effective interest rate are the same in both scenarios. The option effectively sets a floor on their earnings at that 4.56% level after accounting for the premium. They pay for the right to protect themselves, and it smooths out the final return.
Okay, clear. Now, for the other option they considered, the 95.25 exercise price option, this one has a much lower March call premium, only 0.098%, so it's cheaper upfront.
Significantly cheaper premium, yes. That's the attraction.
Right. So let's run the scenarios again. Scenario one. Rates increase by 1.1% to 5.3%. Expected futures price is still 94.36.
Okay. Now, would they exercise this option? Their exercise price is 95.25. The market price is 94.36.
No, because their exercise price is higher than the expected futures price. It wouldn't make sense to exercise.
Exactly. They wouldn't make money by exercising at 95.25 when the market is at 94.36, so they'd let the option expire worthless.
Okay, so what's the result? They still get their full D562,500 from the direct investment, but they did pay that small premium cost, which was D11,025 for this cheaper option.
Correct.
So their net return is a healthy D551,475.
D551,475, and if you calculate that out,
that gives them an effective annual interest rate of 4.90%, which is actually the highest potential rate we've seen so far.
It is. That's the potential upside of using a cheaper out-of-the-money option when rates move favorably, meaning, in this case for an investor, rates going up so the hedge wasn't strictly needed.
Okay, but there's always a catch, right? Let's look at scenario 2. Rates fall by 0.6% to 3.6%. Expected futures price is 96.06.
Right. Now, would the exercise price 95.25, market price 96.06?
Yes, this time they would, because 95.25 is lower than 96.06.
Correct. So their actual investment return is the low D371,250. They get a gain from exercising the options, the difference between 96.06 and 95.25. That works out to D91,125.
Okay.
Then subtract the premium cost again, the D11,025.
Right.
Their net return here is D451,350.
T451,301%. Wow. And interestingly, that is the lowest potential effective rate we've seen across all the hedging instruments and scenarios.
It is. And that highlights the trade-off perfectly.
Yeah. Explain that trade-off again.
Okay. The key with call options, as we saw, is if the exercise price is lower than the expected futures price, you exercise because you can buy at a better price and make a gain relative to the market. If your exercise price is higher than the market, you don't exercise. You simply walk away, only losing the premium you paid up front.
Okay.
Notice how this 95.25 option gave that great return, 4.90%, if rates rose, because they benefited from the higher investment return and essentially didn't need the hedge, only losing the small premium.
Right.
But it resulted in the worst return, 4.01%, if rates fell, because the protection it offered, the gain from 95.25 to 96.06, wasn't enough to fully offset the hit to their investment income, especially after paying the premium. It's a clear trade-off. Lower premium cost, but less robust protection on the downside.
Wow. Okay. So bringing it all together, what does all this really mean for Wardegul Co? Let's just quickly recap those effective annual interest rates.
Sure.
The FRA guaranteed a rock-solid 4.72%.
Yep, certain.
Futures gave a consistent 4.58%.
Also certain, just slightly lower.
The 94.25 call option came in at a consistent 4.56%.
Right. Very close to futures, also locked in.
And finally, the 95.25 call option had the most variability. A potential high of 4.90% if rates rise, but that low of 4.01% if rates fall.
That's the summary. So if we connect this back to the bigger picture for Wardegul.
Yeah, what's the recommendation?
Well, forward rate agreement provides the highest guaranteed return, that 4.72%. So if Wardegul Co. absolutely prioritizes certainty in their cash flow, and they're primarily concerned with protecting against that fall in interest rates, the FRA looks like their best bet on paper.
Okay. Highest guaranteed floor.
Exactly. The 95.25 option, while it offers the tantalizing potential upside of 4.90%, comes with that significantly lower rate of 4.01% if interest rates fall. That downside risk makes it a less suitable choice if Wardegul Co. is at all risk averse.
Right. That downside looks pretty painful compared to the others. But hang on, there's always more to learn, isn't there? This analysis assumes the Urea bank providing the FRA is completely reliable.
Yeah.
What if Wardegul Co. is worried about counterparty risk? The risk that the bank itself might default on that FRA payment?
That raises a really crucial point. Counterparty risk is real, especially with over-the-counter derivatives like FRAs. If Wardegul Co. is indeed worried about the bank defaulting, then the choice automatically shifts away from the FRA.
Because it's just an agreement between them and the bank.
Exactly. They would then lean towards the futures and options because those are traded on an exchange and guaranteed by the exchange's clearinghouse, which largely mitigates that specific counterparty risk.
Okay, so if counterparty risk is a major concern, FRA is out. Then what?
Well, then you compare futures and the options again. The 95.25 option might still be ruled out, perhaps, due to its poor outcome. If rates fall too, maybe that 4.01% is just too low for comfort.
Right.
So then it's between futures giving 4.58% and the 94.25 option giving 4.56%.
Yeah.
The futures offer a marginally better return in both scenarios here.
Tiny difference.
Very small difference. At that point, it might come down to other factors like transaction costs or maybe just familiarity with one instrument over the other, but the futures look slightly better on the numbers in that comparison.
So it really sounds like the decision isn't just about picking the highest number on a spreadsheet. It comes down to Wardegul Co's underlying philosophy, their tolerance for risk.
Exactly right. Remember their treasury team's guidelines? They explicitly balance mitigating downside against capturing upside potential.
Yeah.
So beyond the pure calculations we've walked through, other critical decision factors absolutely come into play. First, as you said, their fundamental level of risk aversion. Are they willing to gamble a bit for a higher potential return with that 95.25 option, or do they prioritize certainty above all else?
Makes sense.
Second, counterparty risk, as we just discussed. How comfortable are they with the bank providing the FRA versus the security of the exchange?
Right.
And finally, their own internal beliefs about future interest rates. Given the volatility predicted, what's their gut feeling? Is a big rate hike more likely, or is drop more likely? If they truly believe rates could climb well above, say, 5.4%, maybe they do lean towards that riskier 95.25 option to capture that potential upside. It all feeds into the final decision.
What a fascinating deep dive into the nuances of interest rate risk management. We've really seen how different tools like FRAs, futures, and options can be used to protect an investment, but each one comes with its own, unique set of trade-offs and potential outcomes. It's definitely never just about one number, is it?
Not at all. Understanding the mechanics, doing the calculations, that's absolutely key. But the real insight, I think, comes from connecting those numbers to the real world business concerns, risk tolerance, counterparty exposure, your own view on what the market might actually do next.
And for you, our listener, this deep dive hopefully shows that being well-informed about these kinds of financial decisions means looking beyond just the headline numbers or the potential best-case scenario. It's really about weighing certainty against potential, understanding those hidden risks like counterparty risk, and seeing the opportunities that each different strategy presents. So next time you're thinking about a major financial commitment or investment, maybe consider this. Beyond just the potential return, what kind of risk, what level of uncertainty are you truly willing to take on, and how might that fundamental question shape the strategy you choose?